is David Scherer. I'm co-CEO of Origin Investments. Thank you for spending time with us this morning. Typically, we start webinars with an introduction of the firm. We're not going to do this today. You are all investment partners. We value your time. We want to jump right in. Origin is a firm that has 2,700 clients, many of which are in this fund. And we're growing very, very quickly. And I think we're growing quickly because of the quality of our products. And we'll get to that with this particular fund, IncomePlus. I'm going to be joined by Marc Turner, who is our head of investment management. Marc's been with us for 7 years. He and his team, which is growing quickly, are responsible for executing business plans in this fund. And he's going to go in detail about our development aspect of our fund, those deals, as well as our preferred equity investments and our deal pipeline. What I'm going to cover is a little bit about market environment, and then I'm going to transition into the roll-up metrics of the fund, and I'll cover aspects of our core and core plus direct equity holdings that the fund has. As always, you have a Q&A button. Please use the Q&A and not the chat button. It just makes it easier for me to make sure we answer all the questions if they're in one place. I'm going to do mine quickly, and I believe Marc will too. I'd like to target 25 minutes of Q&A. Many questions were sent in already, so we'll try to address those in the presentation or in the Q&A. We're very transparent as a firm. We value that, and we want to answer every question that you have. So I'm going to do the first section without slides, but the first section is about state of the market. And in particular, the questions that we get a lot, not just in this fund, but our other funds, are regarding interest rates and inflation, construction costs. This fund does have a small element of construction and development. So we'll cover construction costs as well. And then just the supply and demand equilibrium in apartments. And so let's start with interest rates. So on January 2nd, I believe that was the first business day, the risk-free rate, which I define as a 10-year note yield, was 1.5%. As we sit today, it's 2.4%. I believe it's 2.36. It's a little lower today. But that's an enormous move. It's an enormous move in nominal terms, but in percentage terms, it's massive. And so one of the things that we're seeing is, the question we get is, well, what are you doing? Like, what are you doing to hedge interest rates? And we did a whole webinar on this. Actually, Marc and I were on it together. But the short answer is a lot. We're doing a lot. And the reason is we believe that we operate real estate really well. We believe that we buy it really well. We believe that we develop it really well. And so we want to preserve those margins. And one of the ways you preserve those margins is you fix interest rates, or you put on hedges that are the same as fixing interest rates. And so we're doing both. On a lot of our assets that we own, we have fixed debt. So that obviously doesn't affect us. Rates going up don't matter. It's fixed debt already. But for our construction projects, construction loans are variable rate debt. They're priced over LIBOR or now SOFR. And so you need to figure out a way to hedge that. And there are two ways to hedge that. One is executing swaps with the lender, where you're swapping a variable debt for fixed debt. The other is swaptions. And the reason you would do swaptions is you can't swap debt when you haven't borrowed the money yet. And so when we're building a deal, you borrow as you proceed in construction and have use for the funds. You don't want to pay any interest on something you're not needing at the time. So you don't borrow at all at time zero. And you can't execute a swap cost efficiently unless you have enough debt accumulated. And so in that case, you do swaptions. Why am I spending time on this? Because we've executed over $3.7 million of swaptions at this point for this fund, which secured 68% of our debt. So 68% of our debt is hedged. And that was a very, it was the right decision, and it's proven to be a very smart decision, because we did that when we were about 1.85, 1.9 in yield, and now we're at 2.4. So those swaptions have had a 48% gain on the money that was invested, and that gain we're going to keep it on. We don't intend to exercise. We will keep it on because it's a hedge. And if rates go to 3%, 4%, we'll just keep accumulating more gains. And it's a hedge for the point in time at which we can fix rates, which is our real goal. Our goal is not to make money on a swaption. It's to hedge interest rates to the point where we can put it on either a swap or long-term debt. One of the things you should ask managers, because these are the times that you can show it, not say it. You should be asking managers what they're doing in this environment. Q1 2022 was more difficult than the last 6 quarters combined. Massive movements in construction costs, massive movements in interest rates. Good management teams, this is what you pay for when you enter funds. And I would challenge you with other managers. You should ask them, like, what are you doing? Don't tell me you have a policy. What'd you do? We do a lot here. And the reason is we believe in the margins that we're creating. And we want to make sure that we're protecting the variables we can't control. And interest rates are one of those variables. Construction costs have been incredibly volatile, both on the way up and on the way down and on the way up. And now they're coming down again. Supply chains are part of the problem. Now it's been exacerbated by what's going on in Russia, Ukraine. There's just been a lot of dislocation. It seems like there's a litany of things, and it's always the next thing. So the Canadian closure of the bridges, that really affects transit. I mean, they're a massive trading partner, in particular in raw materials, which we need for construction. Lumber is an example. When you close those bridges, there literally is no trade, and that was 2 or 3 weeks, and so then that was resolved. But then Russia invades Ukraine, and then that's the next thing. So what are we doing in terms of construction costs? A lot. First of all of our projects have guaranteed maximum price contracts, and that really matters. When you lock that in and sign it, all of the risk moves to the general contractor. And I actually met with a general contractor in Jacksonville, a partner we really value. But we signed a GMP, and they weren't quick enough to buy out these raw materials, and they took huge losses. And to their credit, they're paying them. They're a large firm, and they can handle it. It is their responsibility, but that's one of the things we do. Of course, to get to a guaranteed maximum price contract, you have to have plan sets that are fully developed so that they can bid them. So the notion that you say, well, geez, why don't you get there quicker? We're getting there as quick as we can, but it's an iterative process. You want to design the right building to meet demand, and you're also interfacing with the city, you're interfacing with entitlements, et cetera. So it does take time, but our goal is to get the GMP as quickly as possible. We have been doing that. This fund is benefiting from it. Right now, construction costs are leveling off. Some of the raw materials are coming down. The future market for lumber has come in about 25% in the last 4 to 6 weeks, but it's volatile, and we have to manage that. And you're paying for our expertise in managing this, and also our relationships in all the regions with these general contractor firms. I will tell you that even in the world of construction costs being volatile, the margins have never been higher in development. And Marc will get into the specifics of the development of this fund. But this fund is right now going to greatly benefit from the profits that are being generated by our developments. So I don't want people to misconstrue what I'm saying with a negative. It's something we have to manage, but I'm extraordinarily optimistic about these deals. And that's based on valuations of other built assets. We're building these to, for example, we might be building a linen house to 250,000 a door. It's trading 370,000 a door right now. So these are enormous margins that this fund will benefit from. The other thing that's happening is rents, and we'll get into that too, but they've gone up quite a bit, much more than we ever would have modeled. So, these developments benefit from that. In terms of supply and demand, since I mentioned rents, the reason rents are going up is there's simply more demand than supply. It's a very simple equation. In terms of across the country, roughly 700,000 units were absorbed last year and roughly 360,000 were built. That's obviously not anywhere close to equilibrium. So far this year, there's been an extension of that demand. So a lot of times, and you're going to hear about the extraordinary year-over-year rent growth, but you have to keep in mind when rents go up 30% year over year in Chicago, that's a shocking number, but they actually went down year over year the year before on an effective basis because of COVID. So a lot of that was catching up what would happen in COVID, but now the year over year comparisons are actually very accurate, and you sort of have to look at it in a 2-year period. And even in a 2-year period, rent growth has been quite strong. And more importantly, perhaps in Q1, rent growth has continued to be strong. And I think that's what's the fundamentals, the lack of supply relative to demand. By the way, what's going in the residential market, right? So in the residential market, as you know, values have gone up a lot. And now that interest rates are higher, a lot of people just can't afford the mortgage payment. They can't afford the down payment. They can't afford the mortgage payment at a 4% interest rate when they used to have a 3% interest rate in terms of their borrowing costs. So that creates more renters, actually. So, we're the substitute for ownership. Ownership is becoming much more difficult at this point to afford. Okay, I'm going to start, and I'm determined to only take 6 minutes, Mark, I promise, so that I don't leave you with 10 minutes to do your whole presentation. So let's start with the fund roll-up, please. Great. So 240 million net asset value. The share price has been written up 11.06. What I want to talk about a little bit here is portfolio construction. So you as investors, and we're going to do a whole webinar, and I'm going to write an article on this, but I'll just tease this a little bit on the show, this webinar. You don't want to have a portfolio as an investor where all of your assets are moving in the same direction at the same pace. In our world, we call it correlation. You don't want to have completely correlated portfolios and assets. And let's think about Q1 for a second. In Q1, if you had a standard stock and bond portfolio, let's say it was 60-40, stock to bonds, you lost a lot of money on your stock and you lost a lot of money on your bonds. They all moved in the same direction. Bond yields went up, you owned them, that's bad. Equities went down, every index, it's bad. We're looking at a 12% annualized return between dividends, which are 5.7%, and then January and February, we've seen appreciation in the share price. I'm really proud of not just that the returns are high. On a trailing basis, of course, they're much higher because last year was a great year and many of you were in that fund, but on a trailing basis, they're well over 20%. But I'm proud of the fact that if this was in your portfolio, this was something that helped you not have every asset going down at the same time. And in an inflationary environment, if you think about a rising interest rate environment, we've been in that environment for a year now. It's accelerated, but rates were 1% in 2021, right? So we're much higher, and inflation is real. Real estate actually does very well. in an inflationary environment, this is a hard asset, number one, and it's driven by cash flows whose rents reset. And in an inflationary environment, those rents go higher, and that's exactly how it's played out. Excited to report about how the fund performed, but more excited really because if you were in it, it helped to stabilize your portfolio that had a really difficult quarter. On the right, you're looking at the geographic concentration. We do have concentration in Texas, but of course that's across 3 cities. We're in Dallas, Austin, and Houston, and that's both pref and common. Of course, Marc will actually, I will cover the common, but our common investments are in Austin, Houston, and we'll get to that in a moment. And then beneath it is the preferred equity, which is 32.9%. Our preferred equity investments tend to be smaller. It's just because it's a smaller part of the capital structure of deals. So we have to be really prolific to generate that much because the deals tend to be 8 to 14 million. And then of course common equity is 28%. The nice part about those investments is we can depreciate them, and you benefit from that depreciation and the fact that you're generally not paying taxes on the dividends you receive, which is amazing. And then common development, 10.6%. Marc will cover this, but this will be going up quite a bit in the next 3 to 6 months. This is a pipeline we've been working on well over a year, but as I talked about before, that work entails developing, first of all, entitling, but then also having fully contemplated and developed plan sets that you can then take to GMP and work with lenders and get the project started. Those common developments eventually will be core assets in this fund. And so we're building to hold. We're not building to sell. We're building at a huge margin, and then we'll take that margin and produce higher dividends to the fund. And of course, you have the protection and appreciation of what you've done. And then net other assets, this is essentially our cash assets. And these cash assets will all be invested in the next 3 to 6 months. We get this question a lot, and I can empathize completely with it. Probably 40% of the questions we got for this fund was some iteration of, hey, I'm in the queue. I want to get in the fund. How do I get in the fund? How do we speed this up? And I will tell you that we're working really hard to do it, but every investment we make is really, really well thought out, really well researched, high level due diligence. And so what we're not going to do is make hastier investments and less thoughtful investments because we just want to invest all the cash and take people out of the queue and grow. That's not Origin. If you've been a client of ours for the last 14 years, you know that. That's also why we're a top 3%. We say decile, but we're a top 3% global real estate manager, and we want to stay that way. So if you're in the queue and you're frustrated, we're working really hard, and we have a huge deal pipeline, and this will all work through. If you're new and you're a partner or a potential partner, you should join the queue, because the reality is, if you change your mind, you can change your mind. We don't care. There's no harm, no foul there, but it gives you the optionality to join. And this has been a really powerful wealth building fund for the partners who are in it. Next slide, please. So Marc, I almost feel bad covering this because this is completely your domain. But this is tracking our revenue and occupancy. Obviously, we're 100% multifamily fund. That's by design. We focus there because we feel like it's the highest return, lowest risk asset. It's proven that to be true time and time again. COVID's another example. All people did during COVID is pay their rent. It's an essential asset. And so you see that, revenue, which is in the orange, it's a steady increase from March to February. This is what fuels the dividend. This is why we can increase the dividend, which we did. And then obviously occupancy has bounced around. But candidly, for those that haven't heard this before, you really don't want to be higher than 95%. I know it's a little counterintuitive, but you want to be pressing rents high enough that certain people are leaving. You know, at 99%, it means that you're probably undercharging rents, and we're constantly pushing rents. And I'll get to that in a moment on another slide. So 95% with high rent growth is really what we're shooting for. Next slide, please. So I'm going to cover the core plus investments, and then I'm going to transition it to Marc, who will cover the rest, and then we'll answer questions. And we are on schedule. So I'm going to start with Monroe Aberdeen, our Chicago asset, and then for those who participated in the sidecar, you'd be interested in this as well. Monroe Aberdeen has averaged 94.9% occupancy in Q1. That's slightly ahead of the competitive set, but not materially. The competitive set is 94.6. Competitive set just means other West Loop properties that we compete for with renters. Our retention rate, meaning people who re-signed, was 43%. That's okay. We want that to be probably closer to 45, 46. Our competitors were slightly lower at 42. It's cheaper for us to retain a renter than to, have to turn the unit downtime. One silver lining right now is the market's so strong that you're actually getting the same or even higher rent increases on new leases. Typically, that's not true, but right now the market's very tight and strong. In terms of average effective rent increases, it's going to sound incredibly high, but remember, we're doing year-over-year comparisons to 2021, and that was not a good year. But nonetheless, our renewal effective rent increase was 33% in Q1. And what we're proud of is that compared to 15% year-over-year for our competitors. So not really as concerned with 33, but the fact that we beat our competitors by 18% and then still had higher occupancy, I think is indicative of a great job by Marc and his team. Madison at Westinghouse, which is our multifamily direct ownership core plus asset. Actually, it's a core asset more in Austin. This is a deal that since we bought it, really has never had a hiccup. We bought it at an incredibly low price at the time. Candidly, it's the easiest decision I've made in the last 6 or 8 years. I believe I toured it with you, Marc, but we toured it and then we toured the competitive set, and it was the same quality location as everything around it, but we were buying it $25,000 a door cheaper. The whole tour lasted about 30 minutes in my mind, and usually these things take months to make a decision. We did get a great buy because after that, the demand set took over. This is an asset that we bought at, Marc, correct me if I'm wrong, in my mind, it's $160,000 a door. Does that sound right?
Yeah, that's right.
Yeah, I mean, if I'm wrong, it's within 5,000 of that. Yeah. The competitive set is now trading $265,000 a door, to give you an idea of how massive this gain has been. We're carrying the asset at $250,000 a door, so there's a little bit of upside to where this stuff is trading, and we typically do that. By the way, we don't. We always create a little bit of room for more upside in the share price because sometimes there's headwinds in the market too, and we don't want to, fully price the share all the time. But in this case, I think there's 5 to 7% more in this asset at current valuation. So that's 127% gain since October of 2019. And in terms of operationally, it's not just winning from a capital market standpoint. The average rent increase in Q1 is 19.8%. at our asset. And again, Mark and his team, the competitive set only went up 5.8%. So let me just ask Mark, just to make this a little more conversational. How do you do that? Like, how do you beat a competitive set by 14%? That's remarkable.
Yeah, really, it really comes down to, you have to start with ensuring that you're providing the the right experience to your residents, right? So it's the blocking and tackling, the everyday with our on-site teams of, one, we have to have the right physical elements of our property. So we spend a lot of time making sure that we're providing the spaces that people want to live and congregate and socialize in. And then most importantly is the service, the really sort of hands-on, high touch point with residents, especially when it comes to maintenance. If their fridge breaks, you're there to fix it, and then you ask, what else do you need done? And our teams are really well trained and do a great job of that. And that shows up consistently in surveys that we do of residents, and then also online reviews that we really pay close attention to, because that's the best way to tell whether you're doing that job right. Well, people will move. You'll never retain everyone at your property because people have lifestyle changes. They move for a job, they get married, maybe they buy a home eventually. But the people who will continue to be renters, moving's a hassle. We all know that. You'd rather stay. So if you're giving reasons all along during the year for them to stay, they're building relationships at the property because you're creating social events where people can meet and greet. You're providing that great service, and it's a nice place to live. They're going to stay, and they're going to be willing to pay more to stay because you're delivering all that additional value to them. And that's really the key. We also have to be aggressive and not be shy about pushing on our rents, but we would never be in a position to push hard if we weren't providing that value proposition to residents. And that's sort of has to happen every day, not just around the time they come up for renewal, but every single day.
Yeah, and another thing, please, when you talk to management teams, it's so important. It's strategy, sure, and it's experience, all these things, but it's people, right? So it starts at origin. I mean, Mark's team is incredibly talented and it's growing. In Q1, he's hired 2 more people. And those people are going to make this fund even better, right? So he had 4 people on his team, now he has 6, right? So the team is growing. And Mark is really good at training people to be incredible high producers. So that's important to note. And you're right, Mark, reviews don't lie, and they're important. When you shop a property, the first thing you do is you look at the ratings. Yeah. And the proof's in the pudding. We can't make this up. Our ratings are higher than the national average and all of our known competitors, right? So name a publicly traded REIT or name another private equity firm, our ratings are higher. And they're higher because we have a better physical space and better service than others. I mean, that's the only way you win to scale in that game. All right, District at Memorial. This is our Houston direct purchase. So occupancy, I'm just going to do this quickly, 93.3, 43% retention. Again, we'd like to see that maybe 45, 46. But we're increasing our renewals by 5.4%. Here, candidly, I think we can do a little bit better. I think we can maybe get that up to 7, 8%. And Mark's well aware of that, and we're hold us to it. I think we should be able to do that. This investment is up just under 50% since our purchase in February of 2020, 48% to the way that we're valuing this. And we have a process for everything. So valuation is another, but sometimes it's appraisal based, but a lot of the times it's internal discounted cash flow analysis and competitive analysis. But we see enough deals from our acquisition team and our existing portfolio. We're pretty confident we know where the market is. in all these markets. Okay, next slide, please. And I think, Mark, that's our transition point, correct?
Yeah.
And please send in your questions because we want this to be a conversation. Thanks.
Yeah, thank you, Dave. And appreciate everybody joining today. So that, as Dave mentioned earlier, portfolio construction's a critical aspect to the development and management of the fund. And for those investors who've been with us for a while, you'll remember that we pivoted to include up to 20% of the fund capital to be deployed in development deals. And the reasoning behind that is there's a very healthy margin that we continue to see, even with rising construction costs and rising interest rates on development deals relative to buying an existing stabilized asset, what we would call a core plus, similar to the three assets that Dave just described. Those that we benefited by buying those assets at lower prices than they've appreciated in the market over the last 2 years. But if you look at sort of those assets or many of their stabilized competitors, they're trading at what is essentially a yield of in the low to mid 3%. Even with rising construction costs, we're still able to develop in the 5 to 5.2 range and even higher in some cases. And so that's an attractive margin that even if cap rates go up, we don't know where cap rates are going to go. There could be pressure on them with interest rates. Those historically, interest rates and cap rates aren't 100% correlated. There's maybe some correlation, but not a high level of correlation. But there could be, and we anticipate that there would be probably some pressure on cap rates if they go up. But we're still make money on developments because we've built in this very attractive margin. And the other aspect of that is we've assumed in our development projects that cap rates will go up. We've also conservatively assumed that there wouldn't be significant rent growth while we're building construction, even though all of our proprietary model suggests that there will be continued rent growth. Maybe not as strong as what we've seen over the last 12 months, but some continued rent growth in all of the markets that we've invested in. That goes hand in hand with our market selection. So we've got 4 development deals in the portfolio. 3 of them are already underway, under construction. The 4th, Horizon at Sorrento, will be starting here in the second quarter. I'm going to do a quick flyover via Google Earth to give you all kind of a sense of the location of these assets and a little bit of details on them. So let me flip over to that, and I need to share my screen. And Dave, do you see the Google Earth map?
I do. Thanks, Mark.
So I'm going to start with the first development deal that we did in IncomePlus Fund that started last year, and it's Charlotte Avenue project. This is in the west end of Nashville. It's going to be eventually a 320 unit, 5-story wrap development. What we love about this site, it's literally 5 to 10 minutes from downtown Nashville, along what's really become over the last couple of years, and is continuing to sort of develop a high growth thoroughfare of Charlotte Avenue. So it's a main artery that you can take right into downtown and the other areas of Nashville, like Music Row and the Gulch, which are the primary tourist destinations, and also for locals to entertain themselves. But what you're seeing along Charlotte Avenue to the west of Nashville is a rapid growth of really what we would define as urban suburban. So there's a lot of trendy retail, restaurants, and the homes in the area are starting to get redeveloped into sort of significantly higher prices. I'm going to zoom out real quick here just to show you This blue anchor here is the site. Obviously, this Google Earth image was taken before we started development. There were some pre-existing structures on the site. Those have been since demolished, and we've now sort of going almost vertical construction. We've completed most of the site work on the project and moving to sort of the framing of the vertical structure. I'm going to zoom out, just give you a sense. You're nearby I-40, which intersects with other major arteries. You're only 2 miles away from Vanderbilt University, which you see kind of over there in the left-hand corner. St. Thomas Hospital, which is a little further west in this direction, is another major employer in the area. They employ 3,200 workers, and so you're seeing a lot of growth in and around this west end of Nashville to support a lot of these growing employers. But if we zoom out a little further, you're going to get a sense of how close you are to downtown Nashville here over to the left, and so if you're working in downtown Nashville, it's literally less than a 10-minute drive. We've done it in various times at 5 to 10 minutes. So we're really excited about this investment right into the path of growth. We were able to secure the budget for this project before you saw a lot of the significant cost increases. And relative to what assets are trading in this marketplace, we're building in probably about a 40 to 50% margin. So that provides not only for much more significant profit relative to buying an asset like this that's already built and leased, but significant protection if there is headwinds of experience. We have a second project that we're just getting underway in Nashville, and I'm going to zoom to that next. That's called the Northern, and that's in sort of north of the city in a neighborhood called Madison, still within the confines of Nashville. This is going to be a 297 unit surface park development. You see this is adjacent to Interstate 65. This building next to it that I'm hovering over with the cursor is an old hospital that was shuttered some years ago. And one of our partners, the fund isn't investing in this phase of the project, but this is going to be redeveloped into residential living and other retail uses, and we think is going to be sort of a catalytic game changer for the immediate neighborhood. Again, this site, you're only about a 10-minute drive from downtown Nashville, and you're obviously situated next to the major freeways, connectivity to I-65. There's a road called Gatlin Pike and Ellington Parkway, which are pretty fast-moving streets, local streets that will take you to downtown. But what's interesting about Madison is it's in the path of growth. What you're seeing a lot emerging in this area are a number of creative venues, new restaurants, and one of the things that we enjoy about going to a lot of our markets is the good barbecue in Nashville and places like Austin. And there's a number of really good barbecue joints that have opened up near here. And they're not opening up just because they're in Nashville. They're following sort of the migration of people, of population growth, which has started just south of here in another submarket where we've seen explosive rent growth. We believe the path of growth through our extensive data analytics says this is the next stop. And we're already seeing that in sort of other development that's happening, like the hospital redevelopment. You're only about 1.5 miles from a major medical center here. And then obviously, this is an 18-acre site that's surrounding us. Where the blue dot is where we'll be developing. In the back here, they're already developing townhomes, and then the next phase will be to redevelop this hospital into kind of cool loft style living. So those are our two assets in Nashville. I'm going to move quickly to our next location, which is in Belmont, North Carolina, just outside of Charlotte. And just like Nashville, which has seen enormous population growth over the last 10 years, Charlotte is a similar story. And that is only accelerated in sort of the post-COVID or the world we're in after 2020. You've seen a lot of in-migration from the Northeast and even Chicago, where we are, to places like Nashville and Charlotte. And so there's a significant amount of housing that's needed to accommodate the large population growth. What we love about this site and what you're looking at today is basically anyone's familiar with in the South, the kudzu farm. That's a wild weed that grows like crazy. This whole site's covered in it. But we've already started site work. The school image obviously was taken before that. But what we love about this site, and you'll see when I zoom out, is you're really minutes from Charlotte's International Airport. And your close proximity to highways that give you direct access to the uptown Charlotte, its central business district. And the other thing that's really attractive about Belmont, it has one of the highest rated school districts. So when you have an easy commute coupled with really attractive school districts, and it's kind of got a cool little downtown with a lot of local restaurants, really no chain restaurants, a lot of little art and antique stores, and it's really sort of a cool little town. So when you accompany that sort of in a quality of life, good schools, and close proximity to downtown and the airport, those things signal growth. And I'm going to zoom out real quick just to show you how close it is to the airport. I went a little too far, apologies. But downtown Charlotte. So here's the airport. The yellow tag there is our site. You can get on I-85, or you could take local roads and be there within minutes. Traffic in Charlotte is not yet become a problem, even with the significant population growth. And so getting around the city is pretty easy. And then when you're looking to sort of say, well, let me get into uptown, this is uptown here. So it's close proximity. So there's a lot to like about this location. It's in the path to growth, high income area, very strong schools and demographics. The next project that we're going to go to is we're going to zoom down to Florida and Jacksonville. Dave mentioned earlier that he was with our development partner who's working on Linden House in Jacksonville just last week, touring some other opportunities in high growth markets in Florida. And it's a group we are really like to do more business with. We think our experience so far has been really positive, and we think they're a very strong group. We've identified Jacksonville as it's obviously a new market for us. We've never owned or developed in Jacksonville, but through our proprietary modeling, which looks at tremendous amount of data inputs, we identified Jacksonville as a place where we needed to invest. That it was a place of high growth, lower rents relative to some of the other coastal markets in the U.S., which means when you have growth and lower rents, the ability to sort of grow rents. Affordability, if we talked at a number of webinars, and is really a key factor in determining sort of the level of rent growth you're going to have. If people are spending 35-40% of their incomes on rent, you're probably not going to see a lot of significant rent growth unless there's going to be a massive demographic trend. And we know those things don't really change overnight. But what we like about this project, this is going to be a 295 unit, 4-story development. It's 25 minutes southeast of downtown Jacksonville. Image obviously taken before we started construction. It's adjacent to what's known as the Ponte Verde submarket, and that has the highest demos in Jacksonville. But you also have convenient access to what's going to be a 1,600 acre shopping development, which will be the largest shopping center in certainly the east Florida, but maybe the entire Florida. It's called Pavilion at Durbin Park. So you're going to be close to a sort of a very important destination retail, which will have a number of restaurants and other destination type retail and other shopping, high-end shopping. What we're seeing also is you're nearby a neighborhood, a little sub-market called Bartram Park, and it's one of the top selling residential communities in terms of increase in home value in the country. It was ranked number 17 in a recent poll. Median household income nearby within really 3-mile radius of this project is over 124,000. So when we look at that relative to the rents that we need to justify development, that's a 17% affordability. The general rule of thumb is that, you shouldn't spend more than a third of your overall income on rent. And obviously some of those people are going to be home buyers, but with home buyers, home prices skyrocketing in this area, a lot of things that Dave mentioned earlier in terms of, higher interest rates, people don't have the down payment savings. All those items, when you see a 17% affordability, you get really excited about the rent growth prospects. And we believe that there's likely a tremendous amount of upside that we didn't project in underwriting this deal, but certainly could happen. And I'll just zoom out real quick just to give you a greater sense of sort of the proximity to I-95, obviously a major thoroughfare along the east coast of the U.S. and in Florida. You're about 20 minutes south of downtown Jacksonville area, and so close proximity, get on the highway, get to work if you're working in and around downtown Jacksonville. Last project is we're going to flip over to the west coast of Florida, just south of Tampa, the Horizon and Serena project. This project is located in an area called Wimauma. I'm probably butchering that, but that's how I pronounce it. The locals might have a different pronunciation, but this is 28 miles southwest of downtown Tampa. And it's going to be just sit outside of a major housing redevelopment and commercial redevelopment that's going to sit right at our doorstep. And it's really a master plan community that's going to have 650 homes, new retail, new office. And so we're excited about sort of the proximity sort of the path of growth. Today, obviously you see a lot of vacant land, but there's a significant amount of other planned development in and around this project. Again, we're really excited about the demographics in this area. Not quite as good as with Linden House, but in a 3-mile radius, that the median household income is about $74,000, and that more than supports the rents that we need to justify development here. So again, very focused on affordability. We pay close attention not only to the location, we want to be in the path of growth, what's happening in and around to create some catalytic growth, but also sort of affordability. And those things are really critically important to the future rent growth, which is going to really drive the value of this project. I'm going to, that concludes sort of our little flyover of the projects and the development. And I'm going to talk a little bit about sort of our pref portfolio and our pipeline here. So preferred equity portfolio, we have, this is another sort of key strategy within the fund. We've talked about our core plus assets, just talked about our development strategy to create higher margin, higher returns within the fund. Preferred equity, think of that almost like being a lender, though we are an equity partner and enjoy more rights than a typical lender would have. We'll sit behind a senior loan. The majority of these projects are also development projects, with the exception of Ashley Oaks, which is a value add property down in San Antonio. But we typically have invested equity within a capital stack, if you think about a construction loan fills 65% of the total cost to develop a project. We fill roughly the next 20 to 25%. So we're between 65 to 85% of cost. Then our partners have the common equity for the last 15%, and they're in the first loss position. So if something goes wrong in the development, the rents aren't quite what we expected them to be, capital markets cool off, and the values don't support as robust an exit as was projected, we've got a significant cushion. One, our development partners aren't developing this to make no money, right? Just to get their equity out. They're looking to make a development margin of 20 to 30 or more percent. So we've got a pretty significant cushion ahead of us in terms of being in the first loss position. Not only their 15 to 20% of equity invested, but that 30% or more profit. So when we've invested in these deals, we scrutinize them in a similar fashion to what we did if we were in the first loss position, but feel really good about sort of the safety of these investments, given that significant amount of cushion. But what's interesting is that many of these deals have been invested at returns that are above what you would see today for Core Plus projects. Over the last 12 months, many investors who have bought Core Plus projects, if somebody would have bought our Madison project that Dave talked about earlier, they were likely buying that at a leverage return of 8 to 9% and be in a first loss position. So if anything goes wrong, they lose equity, they lose value. With a preferred equity position, we have the cushion and we're getting 12 to 13%. Now, a lot of those returns have compressed as the market has become more competitive, and some of the recent deals, like you see Kingston Point, are at 11%. And that's sort of where the market is today, but it's still at a margin over where Core Plus projects are trading for. So we feel, and we'll feel really great about this strategy and want to continue to grow this strategy. And that's what we'll talk about the next slide with our pipeline of activity. So our pipeline consists of 12 new investments. These are all in due diligence. This isn't even including deals that we're currently underwriting and pursuing. This is only sort of the deals that have a certainty of close. We're finalizing due diligence or development plans on them. Right now, it consists mostly of preferred equity, but we do have some other development projects in our pipeline. This consists of 113 million of equity. This combined with equity that we still have to deploy in the 5 development deals, because you're deploying equity over time as you purchase materials that you need to build and bring on labor. Over the next 6 months, we're going to deploy 125 million of cash. So all that cash that Dave talked about earlier will be deployed in short order over the sort of the next 2 to 6 months. Over the next 8 months, we're projecting that, and deals that we already know that we're going to do, without even counting deals that are still sort of will be considered over the next 30 days, 150 million of deployment. So a lot of activity for the fund, a lot of attractive returns in terms of being pref equity or development opportunities that we're looking at. That's it. I think we moved to Q&A, Dave.
Excellent. Thank you, Mark. Okay, so I will ask the questions, Mark, and I'm going to start with a very specific question that was asked. Thank you for your question that was emailed in prior. And this is a question it's more structural. The question was, because we only take our incentive fee above a preferred return, what would happen if the fund lost money and then made money later in the same year? And how does that all work? Like, would we be getting charged a fee? And the short answer is no. The fund has a high water mark. That's what a high water mark means. It means if we lose money and then make money, we don't charge you the incentive fee. So there's a little bit of nuance in that because we do it annualized. And so if you came in April, it would be a very complicated answer. But the short answer is if you come in January 1st and that happens, you will not be charged an annual incentive fee. And we don't want to take incentive fee, or we don't want to be paid for returns that we didn't earn. We want to be paid for, we want to win with you. And, we do that twice, really. For example, Michael and I are, among the largest investors in the fund. So we're completely aligned with you. But then the whole team benefits when we generate value. And that value is generated not through any sort of financial shenanigans. Like we're very above board about that. Okay, so thank you for your live questions, and I'm going to send this one to you, Mark. I'll answer sort of the business level stuff, and you can answer the specific. Okay, so what is the average expected length of time? Thank you, Noah, by the way, for your question. Appreciate that. What is the average expected length of time to deployment of new capital or new commitments at this time? And by the way, this is the same question that was asked by Roger. I'm sorry, not Roger, by Bella. So thank you, Bella, and others. This is the big question. And so I can answer it, but I'd really like to hear your answer for this. So go ahead.
Yeah, we expect to deploy, as I mentioned earlier, all the capital remaining for these development deals over the next 2 to 6 months. That applies both to the preferred equity deals that are in the pipeline, the existing development deals in Horizon and Sorrento. Typically, on a development project, you're probably deploying equity over 6 to 8 months of the project, closer to 6. And that's as you're bringing on materials. You don't have to buy all the materials you need, obviously. Day one, you're not paying for all the labor you need. And so, though our financing arrangements provide that we put in our equity before we draw on the loan. So we'll be deploying that equity before drawing any financing and paying any interest on that. But that typically, I would say, is a 6-month process. It can be quicker, it can be a little bit longer, but that's probably on average a good rule of thumb.
Thanks, Mark. And believe me, we understand people are frustrated. They want to get into the fund. You're in the queue. You want to get your money working. I get it. It is a balance because we take our diligence and sourcing very, very seriously. That's why we're a top 3% manager. And the fund is growing. It's 240 million now. We will get you out of the queue. And if you're not in the queue, you should join it. Like I said, it's an option, not an obligation. If you change your mind, no sweat. There's plenty of other people that want to take your spot. I have a business question from Roger that I'll answer, Mark. Thanks for your question, Roger. He asks, would it be best to use funds from an IRA or is it better from a taxable account? It's a great question. And the answer, Roger, is you want to use non-tax efficient funds to invest in IncomePlus. So don't use an IRA. Don't use your 401k. Use money that's taxed because the fund is set up to be incredibly tax efficient. So the benefit of IncomePlus, in addition to the returns, is we all are taxed investors. We don't have pensions. We don't have endowments. We have 2,700 taxed investors with the same goals: returns and minimization of taxes. And so this fund is structured to be incredibly tax efficient. So use non-tax efficient funds to invest here. We have other funds. Multifamily Credit Fund, for example, is our least risky fund, but it doesn't have the tax efficiencies this has because it's a bond. We're buying bonds from Freddie Mac, and those bonds are taxed at ordinary income. We do have a subsidiary REIT, which blocks dividend taxes, so it's more efficient than any other bond fund out there. But nonetheless, it's nowhere near as tax efficient as IncomePlus because it doesn't have depreciable assets, and this does. But thanks for your question. Oh, Mark, this is a great one for you. Thanks for your question, Tom. He's asking about our development in Nashville, and specifically, what are we doing to mitigate noise, given that it's on a busy street. Of course, being on a busy street is good for visibility, as long as you have easy ways in and out of the project. It's a good thing. But how do you mitigate the noise in the development?
Yeah, one of the things is you're set back, and so your common areas and your pool area will be sort of have buildings around it to sort of absorb some of that sound. But obviously, the residential units where people are trying to sleep and relax don't want to hear all sort of the traffic noise. And so we spend a lot of time in our design studies looking at, the fenestration, the quality of the windows, the sound quality, the sound attenuation of the windows. And yes, we have to spend more money sort of upgrading those windows that you might do on a project that's kind of on a more quiet or street or set back from high traffic areas. But through those studies, we can tell that sort of when you're in the unit, you don't hear it. And so you have to spend more money upgrading the windows, and that all has to be sort of factored into the return analysis. But that is an important feature that we are very sensitive to.
Thanks, Mark. We have a question from, and I apologize if I mispronounced this. I'm going to say Cyril, so I apologize if I was wrong. Thanks for your question. The question is about our dividend. Do we plan to increase the dividend to 6% or above? Don't know, actually, right now. Remember, a lot of our preferred equity deals are accrual, so they're accruing the return. So that's not current cash, but you get all of the return when it's repaid. That's actually happened quite a few times already. The short answer is we will increase the dividend when it's responsible to do so and funded by cash flows from the properties. So that's our goal, but I wouldn't want to commit to that. I think our dividend is quite high right now, but more importantly, our returns are quite high, and those returns are both the dividend and the accrual pref and the appreciation of our direct common equity assets that actually I went over. But thanks for your question. Here's another great question. I will answer this one as well from Sydney. Thanks for your question, Sydney. They're asking about how we determine where developments go, IncomePlus versus Growth Fund 4. For those who aren't aware, we're raising a market rate development fund. It started to raise January 15th. The demand's been enormous. We've exceeded our expectation in the last few months, kind of by 2x. And so we're pretty. That's going to be a $250 million fund. It looks like that's going to raise pretty quickly. But the short answer, Sydney, is one. IncomePlus can only have 20% of its portfolio in developments, and that's why, because we wanted to give you this fund a variety of investments in development. That's why there's sidecars, because not all of the investment is going in here. It's also going into a sidecar because we wanted to have 4 developments. If we did larger amounts, we'd only get 1 or 2, and then we want more exposure across deals for this fund. But the way that we do it is, as the fund grows, then we can put more development in the fund because it can't exceed the 20%. We want to have a diversified multi-strategy portfolio. As you see, it has core assets, it has development that's really a build to core strategy, and then it has preferred equity. And that's what's providing both appreciation, but also risk mitigation. And what you're seeing here is exactly what you want. Low volatility, high return, and by the way, tax efficient returns. But thanks for your question. Mark, you're going to take us home. This is a question that everyone sort of has in different iterations. There's 3 versions of this, but I'm going to credit Bella. So thanks for your question, Bella. Bella is asking, can I invest today, first of all? And if I do invest today, how long does it take to actually have that money called? So maybe you can answer both of those questions. Can Bella invest today, and how long would that take to be invested?
Yeah, you can invest today, as Dave mentioned. We have a queue set up. So as we call capital, we don't want to call your capital until it's sort of needed to deploy. And Dave's talked about sort of how focused we are on making sure that we can have accelerate a timely deployment of capital. We anticipate deploying the remaining cash in the fund and needing additional cash, probably twice as much cash as we have today over the next six to 8 months within the fund, and good portion of that, the cash that's sitting today will probably be over the next 3 months, to be conservative. So that'll give you a sense of the timing of deployment, and that's not counting deals that we may source that have are further along the development process, that are more ready to shovel ready to go out of the ground, and would accelerate sort of the deployment. But that's where we can what we can see today. So there will be certainly a need to bring people off the queue into the fund, in a relatively short period of time.
So Bill asked another question about how you get in touch with our team. And so you mentioned Katina. Katina is one of our, we have 7 people in investor relations because we really want to deliver. And please give us this feedback too. We want to deliver great service, not just great returns. And that includes being able to talk to people and have your questions answered, and having a high quality, technology in that solution as well. Please give us that feedback. We really value it. Yeah, in terms of Katina or anyone on that team, yes, you can contact them. You can go to our website, and that's a really easy way to talk to our investor relations folks as well. Schedule a call. That's origininvestments.com. And my email is david@origininvestments.com. I always invite people to send me feedback or schedule a brief call and we can talk. Or I'll put you in touch with some of our team members. We have 40 people at Origin, and I can make sure you get to the right people to answer your question. And by the way, people take me up on that. After every webinar, I'll have 2 or 3 calls, and they happen, and I'm available. So if you want that, I'm absolutely available to do that as well. Marc, thank you so much for your time. I know that you're really busy with everything you do, and I think that the Google Earth, it really brought the projects to life. And thank you for your time, everyone that's on it. We'll also be recording this, so people weren't able to join but want to listen to it later. So we appreciate your time, and we'll talk to you at the next update.